Hi, this is for exam. Bit caught short here, so sorry about that. Um, we thought we'd factor in landscape mode, and we're in portrait mode. So welcome to this episode of the Living and Working Abroad show. We're trying to get a bit more organised as we get our projections right. Thanks a lot for joining us today, where we're looking at the pension changes and non-dom changes that are coming up in the year ahead. In the November 24 budget, the UK announced significant changes to a whole range of different things that come into force by April 26 and April 27 to introduce inheritance tax and capital gains tax and non-domicile changes for British citizens. Now, bear in mind that at the moment, you can relocate overseas and change the way that you're going to be paying tax on a whole range of different things. So, if an expat leaves the UK, they don't have necessarily capital gains tax to pay. So, if you leave the UK in the right way, in good time, and in the following year make a decision to sell some capital assets in the UK, then you can defer and potentially avoid paying capital gains tax in the long term in the UK. On the reverse side, um, if you come from another jurisdiction, um, that rule might not apply. So even though you do leave, you can still be paying the capital gains tax. Inheritance taxes are the same. They don't leave you because you go abroad. They leave you at some uncertain time in the future. Now, the definition has been brought in now, but you've got an inheritance tax tail for sure now for 10 years at least after you leave the UK. But under a double taxation treaty, generally at the moment, a UK expat can move their pensions overseas, except if it's a public service pension, and that pension has to be taxed in the UK, even if you're living and working abroad. Um, uh, all these concessions at the moment don't necessarily apply in other countries. In other countries, uh, all pensions are fixed at the home country, and worldwide capital gains are paid all the time, wherever they are. So we've now got a situation where uh, the non-domicile status has changed. You can't leave the UK and necessarily free yourself from taxes in any short period of time. It's a clearly defined period of time which you have to consider in your execution of your um, tax planning and your estate planning in the years to come. So what we want to do today is have a deep dive and look at some of the more further impacts that it could have on pensions. So what is the tax creep on pensions that's going on? We get taxed when we earn money, when we save money, when we profit from money, when we make a gain, and when we die. And that's extended to our pension funds now. So the income that is taxed can be put into a pension plan in the UK, and you get that income tax back, only for the income tax to be paid again when you draw the pension when you get to your retirement age. But now that pension pot you're creating previously could be handed to your family without inheritance tax liability or income tax. Now it's a inheritance tax liability of 40%. So a pension pot, you've got an income tax liability of 45%, inheritance tax of 40%. Is that what you need? Now, if there's a £5 billion being drawn out of UK pensions since November 24 budget, then that's a weird and wonderful thing. The change on pensions was designed to increase the inheritance tax take by £1.5 billion a year. Okay. Now, inheritance tax is going to be rising anyway because there's more and more older people coming up to retirement age. Thresholds for inheritance tax, like thresholds for income tax, have been frozen for many years now, and that's not set to change for at least another 4 years. So £5 billion have been drawn from pension funds by the over 25s within the last year since the November 24 budget. That's at 20%. That's 1 billion extra tax that the Labour government have generated for themselves this year alone. Um, with inheritance tax from April 27, that goes up to 40% as a flat rate tax. So it might be that the ambitions of the current UK governments is to move everybody to a basic rate of 40% from the 20%, but 40% on your pension fund. So whatever your pot is, your family is going to get 40% less. A pension pot can be drawn from age 55. Um, you can't touch it before then. You can save up as much as you like, but not until you're age 55 can you start drawing from that pension pot. So this is where we've got the opportunity, but it could still be that you're going to be planning ahead with this thought process. You might choose not to be putting money into a pension scheme at the moment, but let's assume that you are and you've got money in a pension pot. You can currently draw an unlimited amount of capital from that pension scheme. So if you've got 1, 2, 3, 4 million pounds in that pension scheme, you can draw potentially up to all of it. You don't have to leave the money in the pot to pay the tax. Um, and so it's quite open at the moment and potentially open to being closed off in terms of limiting the amount that's drawn. So when you reach the retirement age, you can draw 25% as a tax-free lump sum. That might change in the future. Um, but what if you limited the amount of the capital you could take as well, say to 25% in any 7-year period or 10-year period? This is a potential change that can be made. I've got no idea, no speculation that that's what they're going to do. But if they're going to want to increase the inheritance tax take, they want to keep the people with the money in the pensions. And it's great if they can take the income tax now, um, which is a bonus. But what they don't want you to do is run your pension down necessarily, so that you've got no inheritance tax to pay at the end. So there's a scope for them to tighten up their rules before April 27. If you make a gift of any capital to your family, um, then at the moment it's inheritance tax free. So if you've got £1 million or £500,000 or £100,000 and you give that to your family, and we're talking about children and spouses, if you give that, it's free of income tax to the recipient and it's free of capital gains tax and inheritance tax on a gift as long as you survive for 7 years. So again, we've got the scope that potentially uh, the exempt gift rule after 7 years could fall away and be removed. So it's a graduated process on that. So if you make a gift of £100,000 today, um, it's still going to be subject to inheritance tax at 40% for 3 years. But after that, it goes down in increments 30, 20, 4, 16, 8% in the subsequent years to reduce the amount of inheritance tax you pay. So even if you're in a bit of ill health, drawing out your pension scheme, so making a gift of a lump sum can save tax when you die. So if you survive 5 years, you're still only be paying an inheritance tax of 16% as opposed to 40% on all your worldwide assets, including your pension funds, for going forward. So making gifts is a good way that you're allowed to do at the moment. And again, there's no indication that they're going to remove this 7-year rule for making gifts free of taxes, because what it does is if you give your children £100,000, that increases their inheritance tax liability. So the money's not lost to the government. It's just whether the government needs that money now. But what we're seeing is that with the thresholds on inheritance tax frozen, the same as income taxes, that more and more families are falling into inheritance tax as it goes down the years. Now, the way a family can defer that at the moment is by making gifts from the estate, which is not in the pension. They've got gifts and they've got no capital gains or no income tax on that process now, but it's just knocking the 40% gift down the line. So not the end of the world, but deferring your tax liability is better than paying it today or when you die. So inheritance tax doesn't go away by making a gift if you've got that money outside the estate. But the money that's locked in a pension is there. If you're a UK resident and you've got a UK pension, you've got a 45% income tax liability if you draw all of it out over 125,000, or you've got a 40% inheritance tax liability when you die. And you can't give it away while it remains in that pension fund. To have to extend that type of embargo to the rest of your assets, that would be a negative thing in terms of the 7-year rule that exists today to make those gifts to the next generation. If you look at the average salary in the UK today, around about £35,000, it's estimated that to get a comfortable retirement, then you need a pension of somewhere between £30,000 and £45,000. The minimum pension, minimum state pension, is around 12, 13, which would be a minimum for any sort of reasonable survival in a pension age. So what does that equate to in terms of a pension fund? To get a comfortable retirement with an income just below £45,000, you need a pension pot of nearly £900,000, 630,000 to get the average income as a pensioner. But even with just a minimum pension, around about the equivalent of to double your state pension, you're going to need £270,000. So there's a lot of money involved, and all these figures very, very close. They're using up your inheritance tax nil rate band, which has been frozen. So the frozen inheritance tax band, which was keeping a lot of people outside inheritance tax, it now includes your pension fund. So if you've got a pension fund of £325,000, that's now going to wipe out your inheritance tax allowance and mean that going forward, you can pay 40% on the cash assets that you've got, on the property that you've got, on your worldwide earnings. Everything you earn is going to be taxed on your death. So what do you want to do to protect your family? Private partnership, we're advising people living and working abroad. You might be living and working abroad in the UK, or you might consider living and working abroad from the UK, and we can help you either way. If you get to the age of 55 and over and want to work remotely or want to retire overseas, then you've got the potential that you can start doing something about the pension schemes. We don't know, but if you've got a government that's progressively, and the UK governments for the last 25 years have always looked to increase the tax take, give you freedoms, but then they tax you for that. So if the inheritance tax rules are tightened up, the amount you can withdraw from your pension at the moment is unlimited. If that's tightened up, if the rules on where a pension is taxed for income is extended from the government service pensions being taxed in the UK to all pensions being taxed in the UK, then your tax planning opportunities as an expat relocating from the UK change for the future. Uh, and all these are potential deadlines that could come in any budget before April 27 changes on the pension inheritance tax. Um, I don't believe the personal allowance on inheritance tax, £325,000 is going to change before April 27, before this current government's term expires. The same with personal allowances, they're not going to change anytime soon. So even to get a minimum pension from your private pension, your fund is going to use up your personal allowance. And everybody else is going to be paying a standard rate of 40%, not 20, with potentially 45% income taxes or 40% inheritance tax when you die. So what can you do? If you want to consider a relocation strategy, uh, then there's actually some interesting options that you've got. When you relocate abroad, uh, you become non-resident. You're only taxed on capital gains in the UK. So if you've got residential property investments or other capital investments to sell, and you make those decisions and choices and sell your business once you're outside the UK, i.e., you work remotely for a few years and then sell your business or your residential property business um, or, or your investment holdings, then you can potentially, at the moment, defer that capital gains liability for up to 5 years, where you remain non-UK tax resident and not pay any capital gains tax in the UK. Capital gains tax in the November 24 budget um, went up by 80% from 10 to 18% of the basic rate and then 24% of the maximum rate. um, the If you go abroad, you can register your pension pot. I've got to take a coffee here, sorry. If you go abroad, you can register your pension pot abroad, and that way you can potentially pay your tax overseas in another jurisdiction. So in the UK, a pension is taxed at between 20 and 45%. In Portugal, between 10 and 20%. In Spain, 18 to 45%. In Romania, an expat will get charged 10% on their pensions. In Dubai, 0%. You've got a cost of living choice, but Dubai is 0% on your pensions. Cyprus is a flat rate 5%. So even £1 million pension fund, you're still going to get a flat rate 5%, and Malta is 15%. So it's a very, very, very competitive options to relocate abroad and have your pension pot taxed abroad straight away. Think of it to the next level. If you've got enough in your pension pot, if you've got around about £900,000 for a comfortable UK state retirement, so private pension income of around £45,000, if you're in Cyprus, you're going to pay 5% tax to draw the whole of the 900,000 out now. In the UK, you pay 45% tax on that. So making a big withdrawal from a pension that's in the UK doesn't save you that much tax. You could pay 20%, you could limit it to your 20% tax band, which is great, but and it's half the inheritance tax rate. But if you consider a tactic of relocating overseas to work the last few years of your business remotely, to pay only no capital gains on your disposals as you manage your affairs while you're working remotely and handing over your business to family or shareholders, then potentially you can enjoy capital gains tax free, and you can enjoy a maximum 5% in Cyprus tax on your pension fund as well. Works for other jurisdictions as well. Whichever jurisdiction you choose, you can pay different rates of tax. I mean, obviously, the Middle East is 0% tax, and that does work. It's a different environment and a different expense bracket to somewhere like Cyprus, for example. But there's cost of living everywhere, the cost of relocating, we understand that. We're talking about how much tax do you want to pay at the end of the day. When we are all going to die, we're paying the tax during our working lives to earn that. The taxes are cranking up and they've increased radically on our capital gains. They've gone up by 80%, from 10 to 18% at the basic rate. And inheritance tax has been extended to pensions. So what do you want to do for the future, and what's the lifestyle that you want in your later working career? Can you work remotely? Uh, do you want to retire abroad, or do you want to operate your business from abroad? These are the issues that we look at with our clients. Don't forget the non-dom status is changing as well. So you can't lose that inheritance tax tail easily. There was a discrete tax plan where you could go to Panama, or you disappear from the UK, and there's no trace on you. But every bank account, every investment account, every pension fund is tied to your tax number, your ID number, your national insurance number, to relate in the modern world. So they can track you, and we do need to do it the right way to manage your income and tax liabilities around the world. So what do you want as an inheritance for your family and for your children? What's the legacy that you want to leave? If you make this choice to work remotely, or to relocate before you retire, so you can then make capital gains, investment choices, and pension transfers to get the capital released. Uh, Package it all up in your own family trust, protected, uh, in your non-dom status, then potentially that gives you a way forward. They could change the rules on how much you can draw from a pension. The moment you can draw an unlimited amount, they could cap that in the future. They could increase the age at which you start drawing your pension from 55. They could easily increase that to 65 or 75 to tie in the money into the UK for longer. The non-dom rules keeps you tied to the UK, so inheritance tax is there for you to be assessed against to get that tax clearance, even though you've left the UK already. So that you're tied in an interconnected global economy, um, and being a UK citizen gives you that tie. If you want to consider relocating overseas, working abroad, contact us at productpartnership.com, and we can help you advise on as an individual, as a business, a holding company, a family, or a business trust, how to hold your assets and protect your family and income across the border, but also down the generations. Thanks a lot for listening, and we'll see you next time.